Thank you very much. Can you hear me okay? Great. Well, thanks a lot to IESBA for the invitation in Lisbon. As Gabriela knows, the city close to my heart, so I'm very happy to be here. Thanks for the fantastic event you put together. And if I may, I'll introduce the panel with a bit of gossip. There was some conversation in the last few weeks around the title of the panel and whether fireside chat would be the right word. And yesterday it hit me, maybe the wine helped a bit, but it should have been, chat by fire or fire chat, because that's what I'm going to try to do. And I need my two panelists to be chief arsonists. So we're going to try to build the fire together and try to get you entertained with this conversation. So my chief arsonists, as they were introduced, are Nandini Sukubar, who is CEO of the World Exchange Federation, and Niels Eckers, who's Global Head of Government and Regulatory Affairs at MSCI. So the way we'll structure this fireside chat is we'll do a bit of scene setting, then we'll deep dive in some of the key issues, and we'll open the floor to some questions. So please do send your questions through the app, and I believe we have a mic going around, so we'll see where we are. But to start with, maybe we'll do some scene setting, and Neil, maybe I'll go to you first, and reflecting on some of the remarks we've heard in the opening remarks from His Excellency the Minister, but also Jean-Paul Sauvé, about how we went through some crisis, some financial crisis, some firms going bust and things like that. Is it fair to say that these are the events that have increased the importance of ethics in financial markets? And has that provoked some sort of shift? Would you describe that there's been a shift over the last few decades?
Yep. Well, thanks, Vincent, and thanks to Gabriela and IESBA for inviting me to speak here in my second home, as Gabriela knows, and on a topic that I'm supremely passionate about. So I'm going to preach a little bit today, apologies. So if you want a fireside chat, you've got the right preacher in front of you. But yeah, you're right. I mean, I've always looked at it in terms of, you can take any sort of stage of the development almost of humankind and try and identify an ethics consideration, and you'll be able to build a story. But given we don't have the time for the full history to do that, I thought if we just look at, from the 2000s onwards, I saw two sort of critical events, which we're all very well aware of, but which I see as having shaped ethics considerations in terms of what we see and experience today. The first was obviously in the early 2000s, the WorldCom, the Enron, the Parmalats. Even in my little world, when I was a bank regulator in South Africa, some banks going down a rather dodgy ethical path. But the focus there, or the remedy there, was the Sarbanes-Oxley type. Let's focus on the individual accountability at firms, focus on the financial reporting so that investors could actually trust what's coming out. And that was all good and well. And then 2008 came along and was a very different risk that we saw, right? Suddenly we saw the world understanding and realizing that whilst we had individual accountability, we were missing the broader systemic risk. And so ethics moved from a consideration to me of just an individual company, but looking beyond that in terms of making sure that ethics protects the global financial stability architecture.
Great, I like it short. We've only got 20 minutes. Okay, Nandini, question to you about, not looking so much at regulation, but in July, your organization published a letter where you warn against, a declining number of IPOs, and we know that private markets are gaining more and more importance to the expense of public markets. How is that impacting public trust, in your opinion?
It's a really, I think, crucial moment. And in starting off, the reason I came today, apart from the fact that everybody comes when Gabriela, calls, is because an organization like IESBA and the topic that we're talking about has never been more important, right? This is the moment. And the reason is, if you've looked at public markets, which everyone takes for granted, that's the nature of public markets. People assume you'll always have them with you. And so what we've seen over the last 20 years, it isn't 6 months, it isn't 18 months, over the last 20 years, we've really seen a secular decline, if you like, in the number of companies being listed on public markets. Why do we care from an ethics point of view? Because all of us, I'm pretty confident in saying, would agree that corporate governance improves the minute a company lists. And why is that? That's because of two reasons. One is because of transparency, operationalized by disclosure. right? So with all of you, I agree that ethics needs to be the foundation of anything that happens in capital markets. That needs to be at the heart of the model. And ethics needs the discipline, if you like, of transparency and disclosure. Otherwise, we all think high thoughts, but how is it working in practice? So if you look at a decline in the number of listings, and the people in this room, I assume most of you are auditors or from an audit background, nobody has any work to do unless companies list on markets. And this is why it's important, because over the last decade, along with the decline in public markets, there's been a growth in private markets. And public markets and private markets are complementary in the ecosystem. But when you have private market growth, the question I ask all of you in this room as auditors, preoccupied as well with ethics, do we know what is happening truly in private markets, given the gulf in disclosure?
That's a fair question. Your letter was also addressed at rule makers and regulators. So what sort of regulatory reforms would you like to see in that?
Let's pick three, and we could go on for hours, but let's pick three.
No, you've got 1 minute.
We'll pick three. Let's pick three. And the first of these is that there needs to be an understanding of systemic risk. And I don't think right now that anyone has a true understanding of systemic risk because of the opacity of private markets. And that isn't only traditional private equity. There are many kinds of new markets that are emerging where there is a high degree, an alarming degree of opacity. The second, I would say, is we need to look at the regulatory incentives, especially around tax treatment, to make sure that they aren't just tilted in favor of one side of the market rather than another. And then the third is looking at disclosure. So much of the conversation focuses on public markets and disclosure. We talk about dual class and people talk about a race to the bottom. But in reality, that's a red herring. Really what we need to be talking about is making sure that disclosure, integrity, trust in both parts of the market are more in sync with each other, that there's less of a gulf between the two.
Good. And to that point, Neil, do you think ethics can be mandated or voluntary codes are more suited?
Yeah, it's a loaded question because I think, and I'll take a sort of maybe different approach to answering the question, because I think, I sort of, and Megan referenced this in the earlier panel actually, I yearn for the days when I was a law student, and yes, I was a law student, so I know I'm amongst the wolves or here as auditors, but we were taught about Justinian and his Corpus Juris Civilis, right, where you had a set of rules or a set of code or a code that was created 1,500 years ago and still had application in the early 2000s in modern day finance. Now I think we're in this place or this sort of, a headspace where it's a regulation a day keeps the doctor away. So we're just seeing this massive onslaught of regulation, rules-based to fit every single criteria, and that means we're having to change it all the time. And so your answer there is no. But do I think we need an absolute baseline? Yes, we need a baseline, but to be controversial, I think that baseline needs to be set very low. And then, dare I say it, but I would love to see a competition in terms of higher ethical standards, not set by regulation, but where not set by common regulation, so not where everybody's driving towards the highest standard. We set the common standard very low and we allow individual jurisdictions to create their own opportunities for what a competitive environment looks like. That encourages growth, but actually I believe will get us to a much stronger, higher ethical standard if we allow that to live as it is, rather than always this relentless pursuit of a common standard, which I don't think we're ever going to get there, just given this massive explosion of regulations.
Competition of ethical standards.
Yeah.
Wow. Next Olympic discipline. Nandini, last question of scene setting. We talked about the regulators. What about the stock exchanges? What's your role in providing trust?
So this is at the start, it's at the heart of the exchange model. And I wanted to say that it goes beyond the stock exchange. In the world that I live in, the stock exchange is one part of the industry. You have derivatives exchanges, you have commodity exchanges. They're all financial exchanges. They all do slightly different things, but they all do fundamentally one common thing, and that is they operate trusted, neutral transparent, regulated marketplaces. And that, you have a rule book, you have rules of engagement, you have regulation. I always say to regulators, many of whom are in this room, that the exchange industry is your greatest advertisement, right? So what is the role of the exchange in ethics? Well, you start with a twin-pillared approach. First, you have to have investor protection at the heart of the model. And I think what concerns me now is that we see new markets emerging which don't have the same focus on investor protection, especially when markets are looking for retail investment. And the second is you do have to have neutrality. You have to treat your participants fairly, because that is the essence of market integrity, right? We talk a lot about integrity in markets when you're a regulated exchange. You know, integrity of conduct, integrity of rules, integrity of behavior, especially whether you're a whether you're an issuer or whether you're like a sell-side firm, a buy-side firm, you know, trading in the market.
But how do you do that?
It's, you set standards. So the exchange is the frontline regulator in every market that it operates. You can either have an SRO model, which we won't go into, but you do it through the standards you set and then by enforcing those standards. And those standards are in your rule book, and they are open for anyone to read on the exchange website.
Right, I think we've gathered the wood. Now I'm going to light the match and see if the fire takes. But, and I'm going back to the welcoming remarks or the opening remarks, and Gabriela said, she listed a very long list of stakeholders that take part in financial markets. And she said something along the lines, and I might misquote you, I'm sorry, that they unified in the belief that ethics matters. But actually, if you think about it, all these stakeholders don't have a commonality of purpose. Even within some of those stakeholders, can you say that impact investor and an hedge fund share a commonality of purpose? Maybe not. So do you, Neil, see these different stakeholders with their different purposes and their different objectives align on their ethics? And what are the challenges and opportunity of collaboration to create that sort of market integrity that we've been discussing all morning?
Yeah, it's a great question. Maybe I'll give you an example of where it's like absolutely relevant in my world. So you have, in sustainability space, you have, exchanges and regulators creating the rulescape in terms of what disclosures need to be, and everybody understanding what that is. You have ESG rating providers like ourselves consuming that information, assigning a rating on the methodology. You have index providers creating a sustainability index, which is consuming the disclosures from the exchanges, the ratings, creating a sustainability index. And then you've got your ETF providers who's actually creating a product, which then sells onto the investor. And each one of those parts are acting, let's say, in good faith, in their own understanding of their ethical world. But there's absolutely opportunities for leakages throughout that structure, right? And very quickly you can have somebody misunderstands a disclosure point, somebody misunderstands a methodology that's been applied, and you have the end investor and the original disclosure not matching. And I think that's just evidence of a very real-world example which is happening, as we speak. Now, what the answer to that is, I don't know, but I think the way I would look at it is the answer is not to require mandatory detailed disclosures from every single part of that, because that's just going to re-emphasize the problem in terms of missing the sort of wood for the trees, to keep your analogy on fire and wood. And instead what we need to do is, again, take a step back, which is the ethical dimension, and have each one of those players look and say, okay, I'm part of an ecosystem. This is what was intention, and this is what's being created. And so it's not just, sort of selfish, this is how I look and this is my own world, but taking a broader step back from an ethical consideration to say, this was intended and this is what's actually happening. So I think that's the way we need to go.
You were looking at me. Do you want to react?
I would say I agree, but that's not very exciting.
I've been trying to find disagreements, but I'm failing.
Yes.
Okay. Shall we have a look at the poll results, maybe? That's a good time, since we're talking about... So 15% high confidence, 81% moderate confidence, and 4% low to no confidence. So in the middle. Well, let's explore maybe where the confidence is lacking. And Neil, let's talk about, there's been a lot of chat this morning around the audit profession. Yeah. And there's been some very nice words said about the audit profession. So let's take the gloves off. I think you have a bit of a controversial views on specifically sustainability assurance. And do you want to share it and we'll take it from there?
Yeah, you set me up there. Yeah, look, again, go back to my, sort of a lawyer with the sheep with the wolves, the wolf with the sheep. I don't know, but look, on financial data and financial assurance, 100% agree. It's necessary. It's needed. We've passed that boat. With sustainability assurance, at MSCI, we don't require that the data is assured yet. Now, the important part there is yet or at this time. I think, and those who have heard me, I've spoken to this many times before over the last few years, my view always with sustainability is we have to create the norm of what disclosure is. Who's disclosing it, what's material, who they're disclosing it to, and what the expectation of investors are. We need that norm to be in place before we then start moving beyond that. And I thought, to be honest, I thought we were there last year, right? I was going to say, right, we're at the place, everybody understands what they have to disclose and how they have to disclose it. And then the beginning of this year, we've had the rug sort of pulled a bit out from under our feet, and there's sands are shifting, and nobody actually knows who's going to disclose what they have to disclose and to who. So for me, at this time, assurance is a luxury. And it's a luxury because I've got CFOs who come to me almost on a daily basis saying, look, I'm spending €1 million, $1 million plus on my annual sustainability report. If I have to have that assured, that's another 30-40% on top of that. I know it's unpopular in this room, but that's what I'm told. And then, I've got to change my reporting team twice in 3 years because the targets keep changing. So now, what does that mean? It doesn't mean that we stop the great work that IESBA is doing. It doesn't mean we stop the great work that ISSB is doing. Those absolutely have to continue, and they have to continue in lockstep with the redevelopment of what the disclosure or the norm is that's being created. Then we'll be ready for when the assurance finally hits, and when all investors call, as they do for financial data, and say this needs to be assured, we'll be in a much better place than where we are now by forcing something that I don't think is quite ready.
You're not going to agree, right?
I'm happy to, say to you, no, I'm not going to agree. But I think also the exchanges sit in a different part of, the ecosystem to MSCI. So for our members, we do a survey, an annual survey, and we track trends across the industry. We're now in our 11th year of that survey. So you have quite an interesting decade-long, a thematic picture of trends. About 5 years ago, our members, and you don't have to be a member to respond, so we have like a lot of exchanges respond. Our members said, we care about assurance. And we sat up because till then, the number one priority for exchanges had been, how do we get to a place where we can, ensure that disclosure is happening in a timely way, in an appropriate way. But the shift in the exchange industry, notwithstanding all the things that you say, which I mostly agree with, but we need assurance because at the end of the day, if you have data, and data is now coming out from the pipes, right? And the exchanges are collecting, there is disclosure, but when you have data, at some point, what is that data? How credible is that data unless it can be assured? And that assurance sits outside the exchange. The exchange is producing the data, for lack of a better word, through collection and through disclosure standards. And then that data comes out, and it has to be assured because that is really what we all know and trust. If you think about greenwashing, which I'm pleased to say I haven't heard yet as a phrase this morning, but comes up in 5 minutes in every exchange, sustainability conversation. With greenwashing, so much of it would be solved, all of it would be solved if we could assure. So we have the data. How can you be confident of the data? I think we're in that part of the conversation.
Fair enough. Okay, with 5 minutes left, let's see if there is any audience questions, either online or I believe there are some mics as well, if anyone wants to chip in the old-fashioned way. Keep going, okay, no problem. Nandini, you mentioned the survey, so beyond assurance, can you tell us a bit of some of the highlights and that decade long of data collected? What sort of key messages did you get from the last survey? Which was recent, right? It was like,
Absolutely. So there are two, actually this year, it's a double whammy. There are two surveys. I won't, you'll be happy, I'm not going to summarize both. The first of which is the actual 11th survey. It came out in July. And the second piece is a thematic work of research we did with our economists who analyzed 10 years of the data. And they're both really interesting. They're consistent. First, the level of engagement with ESG has risen, and that's risen year on year. Two, the number of product, because I always think that product is a solution to a problem that exists. So on the exchange side, when an exchange comes with product, it is because it's trying to solve a problem that the market has identified as saying it needs to be solved. And the third is we're seeing the conversation move out, from beyond climate into nature, into gender, into all kinds of other areas which are loosely categorized as sustainability. And finally, and I'll stop there is increased engagement in the ecosystem with sustainability as well. 5 years ago, 6 years ago, the exchanges were all, reporting increased engagement with themselves, but now you're beginning to see the ecosystem move with them. And that's partly also, the exchange, as I said, is where sometimes it starts. 6, 7 years ago, there were 15 markets in the survey where the exchange was the frontline regulator on sustainability. Now, more or less, most domestic regulators, national competent authorities, are the regulator in the sustainability space.
How does it work for you, Neil? We've got a bit two different views with exchange and data provider, right? But how does it work in terms of remaining neutral in a value-driven investment landscape as a MSCI?
Yeah, I mean, it's interesting because I think a lot of people, when they think about neutrality, they think about neutrality as being like an absence of judgment. And it's anything but, right? I mean, I always look and I compare ourselves to almost like a cartographer, right? Like a map drawer, right? The map, when they sit down and they draw the map, they know what the map needs to generally look like, but there's tons of subjective judgments that are being made every time in terms of where do I represent this line, where do I put that? So in the same breath, we have this, so wealth of data, all unstructured, all very raw, that we have to, from a data perspective, make judgments on. So what our clients are expecting of us and what investors are expecting of us is when we make that judgment, it's free from conflicts of interest. So when we look at neutrality, we look at neutrality in terms of not trying to get to a place where there's an absence of judgment, but rather where there's neutrality, where there's independence of judgment. So where there are conflicts of interest, those are appropriately mitigated.
And I mean, Neil mentioned, developments like the IESBA and the whole standardization of sustainability reporting and disclosures. Nadine, from the stock exchange perspective, I mean, it doesn't come easily, right? There are some challenges in implementing those. I wondered if you could share some of the challenges that some of your members might face while they want to implement it, they might find it challenging in some ways.
So the exchange's role goes well beyond implementation. And what has happened is, in the early years, when the exchange was largely the only one who cared about sustainability, and that was a good 20 years of our lives, it was relatively straightforward. People identified where there needed to be disclosure, what disclosure looked like, and where they were going, and which standard they were going to use. For the most part, exchanges decided that it was better to move to an external standard setter, such as GRI or SASB if you're in the States. GRI was, the most widely used exchange metrics. And then they went off and they did it. But in the last 5 years, 6 years, 7 years, as sustainability has become the party in town, it has become mainstream. Everybody has looked at the exchange and thought, aha, if I can get you to implement what I want, then we're in business. And the reality is, if you're an exchange now, 5 years, you're always in the center of your stakeholders, but you face a barrage of requests, all demanding each individual group saying, we need to be prioritized. You face a barrage of standards. There are voluntary standard setters, there are semi-voluntary standard setters, there are regulators, sometimes there's even the central bank. So really, we find it so interesting that when things began with the IESBA a couple of years ago, there was a belief that things would actually grow less fragmented. And from where you're sitting in the exchange world, while we continue to believe that the direction of travel will be less fragmentation, the reality is there are more competing demands on your time for standards than there have been in the last 5 years.
We've got questions coming in. By the way, we've been given more time, so if you have questions, send them across. We're more than happy to take the time to answer them. So a question from Charlotte Hughes online. From an investor and user perspective, what reforms or safeguards would most likely enhance trust in capital markets? So I think you touched a bit on it earlier, Nandini, but maybe Neil, do you want to add? And then Nandini.
Yeah, so I'm going to go with my anti-regulation. Look, I think, back to my sort of second question, I think, which is, I think we're overcomplicating and confusing the market, and particularly retail investors, with just the weight of disclosures, the weight of labels, the weight of standards. I think we need to simplify it. I don't know how that happens, but I do think we need to go back to principles as opposed to rules. I think if there can be, it's always a frustration for me that I think even in the last panel where I think one of the answers was, what do we do in AI regulation? Like, to me, that's a very sad indictment on where we are as a society and where we are as capital markets, because I long to see the place where we can actually just have trust in capital markets in terms of people doing the right thing. It's ethics, right? People doing the right thing, not having to be told to do the right thing. So I do think I would, dare I say, sort of take the foot off the pedal a little bit in terms of the complication of rules, be more principles-based, and people can then have an understanding of what the expectations are from a principle perspective, and then two, can act in accordance with that rather than trying to pigeonhole into this meeting this label, that meeting that regulation.
But I guess the challenge is the fact that because the entire morning and conversation is angled within the ecosystem, right? But the problem is the perception outside of the ecosystem, because every of the stakeholders within that ecosystem knows that everyone is trying to do the right thing, following some ethical standards. But from an outsider's perspective, I'm the journalist in the room, so I can say that are they actually doing that? And so what's missing there? Is it a communication? What would you say?
Andy, you jump in, but from my communication, you as an outsider, when you read your financial product that you're investing in, how many pages of disclosures does it come with, and how much do you actually read of that?
Putting me on the spot.
Exactly. So how can we find a way that synthesizes? And there's been attempts to do that, but I don't think we've quite got there. But
actually, I was going to challenge you by saying I don't think it's necessarily the case that everyone in the ecosystem is trying to do the right thing. And that is why we come back to the question of ethics, of rules, and of trust. How do you trust? Who is the counterparty that you trust? And if you trust and it goes wrong, what is your legal liability? We're in a room full of auditors talking about ethics. When the rubber hits the road, as they say, will ethics alone be sufficient? And I would be with you, Neil. I would love to be in a place where we can talk just about trust. But we have to be realistic, I think.
Perfect. Another question from Caroline Lee. To you, Nandini, you raised an interesting point about the number of exchanges besides security exchanges. So in your view, who should be the regulator that oversees these exchanges?
At the moment, and there is I don't see any reason, I don't think there's any call to change the structure. At the moment, there is a securities regulator. Normally there's one, of course, in the US, there's two. We've learned, we stay out of it. And in IESBA right now in Europe, there's an interesting conversation, which I will also stay out of at the moment. But typically, there's a national competent authority who regulates the exchanges, both stock and derivatives. Some markets have a different regulator for commodities exchange, but most markets actually don't. They have the commodity regulator is housed within a wider securities regulator. And I think that's an appropriate model because you need to have a holistic view of the risk from different parts of the exchange ecosystem. And also you have to have a holistic view of what's happening, in one part and how that might impact different bits which are not necessarily intuitive.
Great. Any other questions? Yeah.
Am I audible? Oh yeah, sorry.
Yeah.
It's very loud. Too audible.
We can now.
Yeah. So my name is Amarjeet. I am a career regulator. So one question which is bothering all of us in the regulatory space is that there is increasing demand for deregulation, ease of doing business, and so on. So we are grappling with it. So I wanted your take on, does this drive towards deregulation and ease of doing business, is it increasing risk in the system? Is it a threat to trust and transparency? Thank you.
I think, did you hear? I think your question is whether deregulation is a threat to transparency and trust in the market. Yeah.
Deregulation.
Deregulation, yeah.
I'm happy to go first. I mean, the exchanges are the most regulated industry in the world. So I would say that, there's so much focus on regulating more in the regulated entity. And I sometimes, it's the bits that we don't know about. It's the markets that are not being regulated. It's the gaps in the data that exist now that need to be scrutinized. I think that the energy seems to be regulation on top of regulation, and it would be wonderful if there could be maybe an approach where there was a deployment into the bits of the market that need more transparency, that need more focus, that need more understanding of where risk exists.
Yeah, I think that's right. I mean, I was thinking about an example, and maybe just because it's topical in Europe, obviously the omnibus changes that are being made. What I struggle with a little bit, and I know it's difficult, and maybe as a previous regulator I can speak to this, but what I would again like, I don't think regulation or deregulation is wrong either way. I think it's the goal or the sort of end path that sometimes is missing. So when I'm talking about the omnibus is, we created all the regulatory disclosures in CSRD, which was going to require, significant amounts of data disclosure, but there was a purpose behind it, right? There was a goal in terms of meeting, net zero and the responsibility for the financial services sector and, corporate Europe to help us get there. Now we've had a change of approach, and it's pretty much sort of tearing up the rule book. And what I don't know, or what I don't see enough of is, okay, if we tear up the rule book, fine, a mistake was made, or mistakes were made, but what's the end point now? Are we changing that end direction? So if we're going to talk about deregulation, we shouldn't just deregulate because of cost, we should deregulate because we're changing our initial principle or premise from the beginning. And if there's a discussion around that, then I think everybody will be full in terms of how we do it and get there. What I don't want to see happen is deregulation for the sake of deregulation. It's got to be deregulation with a purpose.
Do you currently see purpose in?
I do see purposes, but what I don't see is how that's connected to the original purpose. So that's what I'm saying. I suppose the purpose I see is cost saving, increasing growth, all absolutely valid. But what does it mean for the net zero commitments that were set up at the beginning? How does that translate? And maybe I missed the debate, I don't know, but that's what I think has to happen. I want to go back to the original base case and start from there.
Another question? Yeah.
Federation of Danish Industry. I like the ideas you're talking about, Neil, suggesting that we can incentivize what I would call a race to the top rather than a race to the bottom. I take that as what you are aiming at, and trying to get some of the over-regulation away. And I would also agree saying that robust principles clearly outweigh regulation. But then my concerns kick in, because in very few jurisdictions, and I think that's a question to both of you, you will find a reference to the IESBA Code of Ethics in the audit opinions. Is that a challenge? Or is that essentially because you have the race already? How do you see that? Because I see a lot of other references in the audit opinion to the framework, to the ISA standards, but essentially most of it is local codes of ethics. How do you see that?
Yep. I'll take a stab at that one. I think that there are some there are some ethics that are universal, but for the rest, because we are living in a regulated world, you have to pay attention to local culture. So there are things from an ethics point of view that are relevant in some business cultures and less so in others. I think that IESBA does a wonderful job, and their codes I read and I find, universally relevant a lot, understanding too that there needs to be, we always say we can't have a one-size-fits-all approach because no market is identical. So you need to be able to have that calibration so that it can be appropriate for the market in which it's operating. I'm sure, a code of ethics for the Portuguese market should and will look different from a code of ethics, say, in Brazil, or to one in, America, or one, we represent about kind of 300 markets around the world. So we always say under C, we have Colombo, we have CME Group, which is Chicago, we have the Columbia Stock Exchange. I'm sure that a code of ethics for each of those individual markets should look a little different based on kind of the needs of that market. No.
Yeah, and I think that's right, and I don't know if I'll answer your question directly, but I think IESBA has done a fantastic job of setting that baseline, and I genuinely do believe that we should be seeing IESBA as the baseline. And you were right in terms of your question, in terms of, but from there's an opportunity for competition onwards, and that's where I'd like to see the adjustment, as opposed to not having IESBA as a starting point, as the mandatory base.
But I think IESBA fulfills a really important role, and one that was waiting to be filled. I mean, as I said, your time is now. People care about ethics. People are talking about ethics, where before it was seen as a somewhat more arcane conversation. It's a mainstream conversation now, and there is an urgency about it.
That's it. I think we've got more questions.
So Mark Babington, IESBA member and also a regulator. A couple of reflections that interested me from the panelists. So firstly, the importance of transparency in our capital markets. Yet I think you said, Neil, how many pages of that stuff do you read? And it sort of says, if you take the sort of ethical approach that professional accountants and auditors are supposed to use with the diligence in their work, is it not right that you've got users of all of this information not accessing it and digesting it in making their recommendations on for how people invest in our capital markets? And then there's also that question about gaps in information and it needing to be assured. And it's how can we make sure that we're actually grasping the benefits of innovation? Because we heard about what's happening in, say, the auditing profession, greater use of technology, greater use of AI. Can we not use things like structured digital reporting, access to information more readily, the ability to synthesize huge quantities of information and inform it? And I think one of the important things is when we think about ethics, we think about it in the context of a profession, but it's actually also something that reflects on all of the users of the information that profession helps to generate.
Yeah, I'm happy. I think, Mark, don't get me wrong in terms of saying that we shouldn't have disclosures. Absolutely, disclosures are critical and absolutely are critical for different users. My reference point was specifically on the retail side in terms of how do we ensure that we're getting the information that matters. And your point is 100% valid, because technology can help us get there. The next question is going to be how do we synthesize that, and what then controls do we put in place for the synthesis of that information to actually be readily available? That's going to be the next challenge, and I think ethics has a huge part to play in that.
I think in terms of disclosure, I think if you have 40 pages of disclosure, the chances are that people won't read it. But what is of greater concern is that there are new markets that are emerging, which are selling to retail now. The crypto, the digital market, the digital asset market is, a retail market. Its genesis is a retail market. If you look at some, private markets want to be selling into retail. How do you protect the investor? And I speak absolutely from the perspective of, a public market and exchange where people understand what a loss of trust can mean. it will never come back in a generation.
Fantastic. Well, I think we've reached the end of our time. Just a couple of sound bites that were interesting from my side to sum up. It would be wonderful, Neil said, if we had trust without regulation. However, Nandini warned we need to be practical. Nandini also said that sustainability assurance will kill greenwashing. But Neil warned this is a luxury at this stage. And ultimately, I think the best key takeaway for the audience today is that we need to organize some Olympic Games of ethical standards. That came from Neil, followed by Nandini, who said, IESBA, now is your time. People care about ethics, so seize it. So, ladies and gentlemen, if you can join me in showing your appreciation to the panelists.